The US dollar kicked off the week consolidating near its 3-week highs. This sideways movement can be attributed to market participants preparing for the upcoming Fed Reserve meeting. The key factor here is not the interest rate level itself. This time around, the regulator is widely expected to cut rates. However, at the next meeting in January 2025, Fed policymakers may choose to pause. Therefore, the focus will be on clues about the future path of the US interest rates, both in the short and the long term. In the meantime, let's take a look at the other reports scheduled for today and assess how they might affect trading instruments. You are watching Traders Calendar. Wednesday traditionally adds volatility to oil prices as markets receive weekly inventory reports from the United States. This day features two key reports, one from the American Petroleum Institute, API, and other from the U.S. Energy Information Administration, EIA. Notably, the API data is based on voluntarily submitted figures, making it somewhat limited. However, markets often treat this data as an indicative of a trend. For example, the last 2 weeks saw much higher than anticipated figures, which weighed on oil prices. The official AIA data is also expected to show a modest inventory increase of 153,000 barrels, which could add to downward pressure on oil prices. And this could also have a negative impact on the Australian dollar as a commodity currency. Domestic statistics are expected to further weaken the Aussie, with the consumer confidence forecast to fall from 5.3% to 3.2%. As a leading indicator, the Consumer Confidence Index sets the tone for Australia's economic outlook in the coming months. A decline in this figure will be a negative factor for the Australian dollar. The Japanese yen is also poised for losses. In the trade balance report, export growth is expected to slow down from 3.1% to 0.3%. The decline is likely to be driven once again by weaker sales of transportation equipment abroad, which fell 4.4% per annum in October. Typically, a strong economy also fuels rising prices. From this perspective, an expected increase in the UK inflation is likely to be a solid factor supporting the British pound. Forecasts are for a 0.2% increase in November, bringing the inflation rate to 2.5%. The retail price index is also expected to rise, with a year-on-year reading forecast to accelerate to 3.7%. With the British pound making up nearly 12% of the US dollar index, this data could lead to a reversal in favor of pound sterling. The Eurozone will also release inflation data 3 hours later, and the annual inflation rate in the euro area is expected to rise from 2% to 2.3% per annum. Notably, a sharp drop in the energy prices last year is no longer factored into the calculations finally, meaning that its downward pressure is not relevant for the updated report for the November. Against this backdrop, the euro will have a chance to strengthen. And however, the euro's bullish run is likely to be short-lived, analysts noted. Later in the day, market participants will shift their focus to the United States statistics. And in particular, the United States will release data on the housing sector, which is likely to support the greenback. US building permits are estimated to have risen to 1.1,430,000 in November. And these strong figures are positive for the stock market commodities and commodity currencies. Please note that the publication times are set in a GMT +3. We wish you profitable trading and see you soon.